gold just shattered $5,500 an ounce. Silver has surged over 145% in a single year. And here's the thing, most people have no idea why it's happening or what comes next. This isn't just a price spike. This is a full-blown market shift. Central banks are dumping dollars and stacking gold at record levels. The Federal Reserve's independence is being questioned like never before. Geopolitical chaos, from Iran to Greenland, is sending investors racing toward the one asset class that has protected wealth for thousands of years. But gold is only half the story. Silver, the most undervalued metal on the planet right now, is where the real opportunity is hiding. Industrial demand from solar panels, electric vehicles, and AI data centers is exploding. Supply deficits have stretched for 5 consecutive years, and mines can't keep up. Analysts are already eyeing triple-digit silver, and we're still in the early innings. Whether you're a seasoned investor or someone just starting to pay attention to where smart money is flowing, the next 12 months could be a defining window. The fundamentals aren't just strong, they're historically rare. I'm breaking down exactly what's driving this shift, which metal has more upside, and how to position yourself before the next leg up. If this kind of insight is valuable to you, and I promise you it is, hit that like button right now. It takes 1 second and it tells me to keep bringing you this kind of content. Let's get into it. So let's start with what's actually happening here. Because if you only read the headlines, you're missing the deeper story. Gold hitting $5,500 is a number. It's impressive, no doubt. But numbers without context are just noise. What matters is why gold is doing this, and more importantly, what it's telling us about the health of the global financial system. Because here's the truth that most mainstream media will not spell out for you. Gold is not rising because people suddenly love shiny things. Gold is rising because the world is losing confidence in the dollar, and the institutions that are supposed to protect your wealth are the very ones driving the crisis. Let's talk about the dollar first, because everything, and I mean everything, flows back to this. For decades, the US dollar has been the world's reserve currency. That means when countries trade with each other, when central banks store wealth, when governments issue debt, they do it in dollars. It's been the foundation of the global financial system since the end of World War II. But that foundation is cracking. De-dollarization isn't a buzzword anymore. It's a measurable, accelerating trend. Central banks around the world, especially in emerging markets like China, India, and Turkey, are actively reducing their holdings of US dollar assets and replacing them with gold. This isn't speculation. The World Gold Council has tracked central bank purchasing for years, and the numbers are staggering. Central banks bought over 1,000 tons of gold in 2022, again in 2023, and again in 2024. 3 consecutive years above 1,000 tons, levels not seen since the 1950s. And 2025 continued that trend, with purchases well above historical averages. Why are they doing this? The answer lies in what happened in 2022 when the West froze nearly $300 billion in Russian sovereign assets after the invasion of Ukraine. That single event sent shockwaves through every finance ministry on the planet. Suddenly, countries realized that holding your wealth in US dollars made you vulnerable. If the United States could freeze your assets overnight, how safe were your reserves really? That realization, of what analysts are calling jurisdiction risk, triggered a structural shift. Reserve managers started asking a very uncomfortable question. If the dollar can be weaponized against us, what do we hold instead? And the answer, as it has been for thousands of years, is gold. It's not tied to any government. It can't be printed, can't be digitally created, and can't be frozen in a server somewhere. It just exists. And right now, it's the single most trusted store of value on Earth. Now layer on top of that the United States' own fiscal situation, and the picture gets even more urgent. The national debt is not just high, it's on a trajectory that most economists consider unsustainable. Deficit spending shows no sign of slowing down, and the servicing costs on that debt are consuming a massive and growing share of federal revenue. Major institutions like JP Morgan, Morgan Stanley, and Deutsche Bank have all revised their gold price targets upward, and their reasoning isn't complicated. When a government's debt becomes too large to manage through normal means, the path of least resistance is to inflate it away, and inflation destroys the purchasing power of cash. Gold, on the other hand, has historically held its value through every inflationary period in modern history. That's why, for the first time since 1996, gold now accounts for a larger share of central bank reserves than US Treasuries. Think about that for a second. The institutions that manage the world's money are choosing gold over the dollar. That's not a footnote. That's a headline. And here's something that reinforces just how serious this trend is. Gold ETF inflows, exchange-traded funds that hold physical gold, have been pouring in at a pace not seen in years. Investors from North America, China, and India are all flooding into these products simultaneously. The Sprott Physical Gold Trust alone saw 1.5 billion in US inflows in 2025. Gold ETFs in Europe attracted over 2 billion euros since the start of 2026. And money market funds in the US are sitting on a record $7.5 trillion. That's money on the sidelines, waiting. If even a fraction of that rotates into gold as rate cuts materialize, the demand picture becomes even more powerful than it already is. Institutional investors are no longer treating gold as an afterthought or a crisis hedge. Morgan Stanley noted that institutional portfolios have been increasing their baseline gold allocations from around 5% toward 10%. That's a doubling of allocation for the biggest money managers on the planet. When that kind of structural reallocation is underway, it doesn't reverse quickly, so that's the macro backdrop for gold. But here's where it gets really interesting, because gold isn't the only metal benefiting from this shift, and in many ways, it's not even the metal with the most upside from here. That would be silver. Silver is a fundamentally different animal than gold. Yes, it shares gold's safe haven characteristics. People buy silver when they're nervous about the economy, just like they buy gold. But silver has something gold doesn't have: massive and growing industrial demand. Silver is one of the most electrically conductive materials on the planet. There is no substitute that performs as well. And right now, the industries that need silver the most are growing at a pace that the global supply chain simply cannot keep up with. Let's talk about solar energy, because this is the single biggest driver of silver's industrial story. Solar panels use silver paste, a critical component in how they convert sunlight into electricity. And global solar capacity is not just growing, it's accelerating. The International Energy Agency has projected that solar capacity could quadruple by 2030. Solar manufacturers consumed over 200 million ounces of silver annually as of 2024, and that number has gone up every single year since. By some estimates, solar alone could consume the equivalent of 85 to 98% of today's known silver reserves over the next few decades. That is not a typo. The energy transition isn't a trend, it's a structural rewriting of how the world generates power, and silver is at the center of it. Then you have electric vehicles. EV-related silver demand jumped an estimated 20% in 2025 alone. Every electric vehicle contains silver in sensors, in wiring, in the battery management systems that keep these cars running safely at high speeds. As the global auto industry shifts toward electrification, silver demand from this sector alone is going to keep climbing year after year. And then there's artificial intelligence. AI data centers consume enormous amounts of electricity, and the hardware that powers them relies heavily on high conductivity metals like silver. This is a demand driver that barely existed 5 years ago, and it's now one of the fastest growing segments in the entire industrial economy. Every time a tech company builds a new data center to support AI workloads, more silver goes into that infrastructure. And we're talking about massive infrastructure buildouts, the kind that consume millions of ounces of metal per year. Beyond data centers, the broader tech sector is also pulling silver in new directions. Advanced semiconductors, 5G network equipment, and high-efficiency electronics all rely on silver's unique conductivity properties. There is no material that performs as well at the nanoscale. Engineers have tried repeatedly to substitute silver in these applications with cheaper alternatives, and every single time the performance has been inferior. Silver isn't optional in these technologies, it's essential. The demand curve for silver isn't just going up, it's steepening. But here's the part that should really make you pay attention: supply. Silver supply is not keeping up with any of this demand, and it hasn't for years. The Silver Institute confirmed that 2025 marked the 5th consecutive year of a structural supply deficit. That means global demand for silver exceeded what mines could produce, 5th year in a row, and the reasons this deficit persists are deeply structural. About 75% of silver is mined as a byproduct of other metals like copper, gold, and zinc. That means silver production doesn't respond the way you'd expect to rising silver prices. Miners aren't drilling new silver-specific mines because the economics don't work that way. Silver comes out of the ground alongside other metals. And whether miners expand production depends on the price of those other metals, not silver. Even at record silver prices, new supply isn't coming online fast enough. Most new mining projects that have been proposed won't produce meaningful output until 2027 or 2028 at the earliest, and even then, permitting and regulatory hurdles add years of delay. The physical tightness we're seeing in the market right now isn't temporary. It could be the new normal. Above ground inventories are draining rapidly as well. Exchange stocks in Shanghai have fallen to their lowest level since 2015. London vaults, one of the primary storage locations for ETF-backed silver, have seen notable drawdowns as metal flows to India and across Asia to meet demand. Lease rates for silver spiked above 5% multiple times in 2025, well above the near zero historical norm. That's a sign that physical silver is genuinely scarce, not just on paper, but in reality, right now in the world. So you have rising demand from multiple directions and supply that physically cannot keep up. That's a recipe for significantly higher prices. And the forecasts are starting to reflect that reality. Bank of America projects silver reaching $65 per ounce. Some technical analysts see 72, 88s, and potentially higher if the gold to silver ratio continues to compress. And then there are the more aggressive calls. First Majestic Silver's CEO has said that triple-digit silver is definitely on its way. Whether silver hits $100 this year or next, the trajectory is clear. The structural forces aren't going anywhere. Now, here's a question a lot of people ask, and it's a fair one. If gold and silver are both going up, which one should you be looking at? The answer depends on what you're trying to accomplish, but I'll give you my honest take. Gold is your anchor. It's the metal you hold for stability, for protection, for the long haul. When the world gets scary, and right now it is, gold is the asset that holds steady while everything else shakes. Major institutions like Morgan Stanley and Goldman Sachs have price targets for gold that stretch well above $5,000 by the end of 2026. And the structural demand from central banks and ETF investors gives gold a solid floor. If you don't have gold in your portfolio, that's the first conversation you need to have with yourself. But silver is where the asymmetry lives. Asymmetry means the potential upside far outweighs the downside risk. Gold has already had its breakout. It's up over 60% in 2025 alone. A lot of the easy money in gold has already been made. Not all of it, but a significant chunk. Silver, on the other hand, is still in the early stages of its repricing. It entered 2025 at around $30 an ounce and has more than doubled. But relative to gold, relative to its industrial fundamentals, and relative to the supply deficit it's operating in, silver remains dramatically undervalued. The gold to silver ratio, which measures how many ounces of silver it takes to equal 1 ounce of gold, has historically averaged somewhere around 15 to 20. Right now, even after silver's massive run, that ratio still has significant room to compress. Every point of compression means silver is outpacing gold, and with the industrial tailwinds we've talked about, there's a very strong argument that silver has more percentage upside from here than gold does. That said, I want to be transparent about the risks, because this isn't a one-way street. Silver is significantly more volatile than gold. It swings harder in both directions, and history backs that up. During the 2008 financial crisis, silver dropped nearly 50% in a matter of months before eventually surging over 400% in the recovery that followed. It's not for the faint of heart. If the global economy contracts sharply, or if the Federal Reserve reverses course and starts hiking rates, which most analysts don't expect, but it's not impossible, silver would feel that pain more intensely than gold. Industrial demand is sensitive to economic cycles. If manufacturing slows, if trade wars escalate to the point where global growth stalls, silver could pull back significantly in the short term. Timing matters. Buying silver in a panic at the top of a spike and holding through a correction is a completely different experience than building a position gradually over time. So the position sizing matters enormously. Silver shouldn't be your entire strategy. It should be a meaningful allocation within a broader precious metals framework that includes gold as the foundation. A common framework among precious metals strategists is to hold gold as your core defensive position, maybe 60 to 70% of your precious metals allocation, and allocate the remainder to silver for its higher growth potential. That ratio can shift depending on market conditions and your personal risk tolerance, but the principle is the same. Gold protects, silver amplifies. The other piece of the puzzle that's worth understanding is what's happening with the Federal Reserve, because monetary policy is still one of the most powerful forces shaping precious metals prices. The Fed has been under intense political pressure to cut rates, and it did cut multiple times in 2025. But inflation has remained stubbornly above the 2% target, which puts the Fed in an incredibly difficult position. If they cut too aggressively, inflation accelerates. If they hold rates steady or raise them, the economy risks slowing or contracting under the weight of existing debt. This is what economists are calling a policy trap. There is no clean exit. The debt levels are simply too high for normal interest rate policy to function the way it used to. Either way, gold and silver tend to win. Lower rates reduce the opportunity cost of holding non-yielding assets like precious metals. And if inflation persists despite rate cuts, the real value of cash and bonds erodes, making hard assets even more attractive. Meanwhile, comparisons to the 1970s stagflation era are becoming increasingly common among serious economists. Just as gold served as an escape hatch during the Nixon and Carter administrations, when confidence in the dollar was crumbling, the current environment shares many of the same characteristics. A new Fed chair is expected to be appointed in 2026, and the market is watching that closely. If the replacement leans more dovish, more inclined to ease monetary policy, that would be another significant tailwind for both gold and silver. So where does this leave you? It leaves you at a moment in history where the macro backdrop for precious metals is as strong as it has been in decades, arguably stronger. De-dollarization is accelerating. Central banks are buying gold at record levels. Silver is in a structural supply deficit with demand growing faster than supply can respond. The dollar is weakening. Fiscal deficits are mounting. And institutional investors, the kind of money that moves markets, are increasing their allocations to precious metals for the first time in a generation. This isn't a fringe view, this is mainstream Wall Street consensus. JP Morgan, Deutsche Bank, Morgan Stanley, Goldman Sachs, they've all raised their price targets. They've all acknowledged the structural nature of this rally. The question isn't whether gold and silver deserve to be higher. The question is how much higher and how fast. If you're watching this and you haven't started paying attention to precious metals, now is the time. You don't need to go all in overnight. You don't need to drain your savings account and buy a vault full of bullion, although some people do, and there's nothing wrong with that. What matters is understanding the shift that's happening, building a strategy that makes sense for your situation, and positioning yourself before the next leg up, not after it. The smartest investors I know aren't trying to time the exact top or the exact bottom. They're building positions over time, dollar cost averaging into physical gold and silver, or into physically backed ETFs that hold the real metal. They're treating precious metals not as a speculation, but as a core part of how they protect and grow their wealth over the long term. And given everything we've talked about today, the de-dollarization, the supply deficits, the institutional buying, the fiscal crisis unfolding in real time, that approach has never made more sense than it does right now. There's also a bigger picture point here that I think is worth sitting with. We live in a world where the news cycle moves fast, where markets are noisy, and where it's easy to get caught up in whatever the hot trade is this week. But the most powerful wealth-building opportunities aren't found in the noise. They're found in the signal and in the structural trends that unfold over months and years, not hours and days. Gold and silver in 2026 are that signal. The fundamentals behind this move are deep, durable, and reinforced by the actions of the most powerful financial institutions on the planet. This isn't a meme stock. This isn't a crypto pump. This is the oldest form of money in human history, reasserting its value in a world that has temporarily forgotten why it mattered. I'll be diving deeper into specific strategies, how to actually buy and hold gold and silver, and which vehicles make the most sense for different types of investors in upcoming videos. So if you found this valuable, and I genuinely hope you did, you would make sure you subscribe and hit that notification bell so you do not miss what is coming next. And if you learned something today, share this video with someone who needs to hear it. The more people who understand what's actually happening in these markets, the better off we all are. This is just the beginning. Stay close.